Welcome back to Morning Trade Live. Time to go inside out on Palo Alto Networks ahead of the company's report. Joining me right now, Nathaniel Bradley, CEO of Data Vault AI. What are you going to listen for when it comes to Palo Alto's report this afternoon? What part's most important?
Well, quite honestly, I look for their continued growth. This is a company that has a complex product. Oftentimes, it's educating their clientele is the challenge. They have an opportunity to provide scalable tools, at the very forefront of the battle, in the space they operate, cybersecurity. You really can't say, you can't say that artificial intelligence and supercompute is at the forefront of these markets without next talking about the security of those markets. Palo Alto is the tip of the spear. They have a very important role to play, and you're going to see this role continue in its importance and growth. This company has to deal with that exceptional demand and apply a team here that makes the complex consumable, makes their software executable, and therefore I think they're going to continue to grow. I look for them to beat the estimate with respect to their earnings per share. This is a stock year over year that is approaching a 20%. If you look at the future of this stock, I'd look for it to continue to grow.
And so are companies becoming frustrated? I read this morning. Companies are becoming a bit frustrated with the spending they have to do on cybersecurity, the tools and the labor. Is that something that companies may start to cut back on? Can they even do that?
Well, absolutely. So, you have a number of demands, none more central than cybersecurity in terms of how we're going to address this. Palo Alto Networks, it's not a nice to have, it's a have to have. And when you look at that, in terms of the sophistication of that purchase, their problem is largely educating their customers on how to buy and how to fit it into these budgets that are constrained. Everyone faces constraints in these markets. And cybersecurity is not something you can cut out of that budget. And therefore, I think Palo Alto is in a strong position there, but they also too must educate that market on the other side. They also, with their clientele, they absorb a great deal of risk. They have a high touch relationship, and they have no touch software. So if they can teach others how to implement, is kind of the rub or the slowness of it. But the demand is there, and this company's responded well. They've been dead on with guidance. They seem to have a very, very good handle in management about what they're capable of doing, and they're marching forward in growth. And they're also careful here, where they have done a good job protecting their customers, which is really the measure of this sector.
And what about the CyberArk deal? An important part of the story. Let's hear what they might say about that.
Well, I think the CyberArk deal is indicative of quality contracting and the ability for this management team to illustrate how their solutions are brought to market. Again, there is, in this contract, scale, and what I like about that is they're able to push software solution and scalability, and here as they can have less of a touch but higher in scale, they're able to increase their margins and get their product to market. I think the challenge in this marketplace is really, you mentioned it, the budget constraints that companies face to get top tier cybersecurity. Palo Alto has been a right priced product in this marketplace, and they seem to have a good feel for how they can grow in that mid-tier sector. So I like that deal. I like a number of the deals that they've entered into. I think management here, has a revenue surge that they are struggling to control the amount of demand that they face. and how they bring their product to market, which is an interesting challenge, combined with that you're waging war, cybersecurity war, and this company's the tip of the spear for many of their clients, and that comes with a lot of its challenges for this company. But it's an exciting sector and something that's not going away, and it's going to continue to grow. These companies have to do a good job in waging that cybersecurity war, and they also have to infiltrate their customer base, get into their customers, and teach their customers how to protect themselves. And that's a challenge. But you can see some of these deals are towards scale and moving the company to much higher margin and I think future success.
When we look at, thank you for that, PANW is often a top pick for guests in the cybersecurity name. Is it the best in class? Do you like many of the names in the group? What names do you think are the best bets?
So I think Palo Alto stacks up nicely. I've always liked CrowdStrike. I think CrowdStrike offers a unique advantage in some of their intellectual property. And their market approach is a bit different. But I think the two of these companies, CrowdStrike and Palo Alto, represent the best of the sector. And the management, I think, is exceptional at both companies. In particular, I like CrowdStrike's leadership. I think they have a vision for the future in protecting companies in cybersecurity. And these companies are vitally important. The competition between them, vitally important to keep us at the very cutting edge in this industry, keeping our edge as American companies need protection. So competition is going to help us maintain the very best technology in the space. So I like CrowdStrike. I like Palo Alto in this space. In particular, those two companies have a good part of a portfolio. I think you need to look at diversity whenever investing in these companies. Realize they're waging war, and anytime they lose a battle, it's very catastrophic to the stock price. So these companies are at a zero tolerance or a zero loss type stature. They must always win that cybersecurity war. And that's the risk in this space. Also, their ability to execute. These are two companies doing a great job of that.
Nathaniel Bradley, CEO, Data Vault AI. Thank you. Appreciate it. Now it's time to trade it. Tom White, host of Fast Market, is with us, and you're looking at Palo Alto. You have a couple of example trades. The first one here is a bullish trade. Could you explain, please?
Yeah, hey, Nicole. The option market priced in about a plus or minus 7% move in the shares. Implied volatility levels relatively elevated going into this report. As you mentioned, it's pulled back over 15% from those all-time highs post the announcement of that CyberArk deal. So maybe some opportunities here. The first trade I looked at, a little bit more bullish, a little bit more aggressive, but also not a pure earnings play. I went out to the September monthly options. So 32 days to expiration on this one. So gives myself some time for this stock to continue to rebound, even if we don't get that move post earnings. So buying the basically at the money 177.5 strike call, and then against it, we're going to sell the 200 strike call. So with $22.50 wide, bullish call vertical here, you're going to pay roughly about a $7 debit for it. Might be a little bit cheaper than that right now. The stock's down about 1% today. But if you pay that $7 debit for it, takes your break even up to $184.50 over the next month. That's about 5.5% above the current share price. So well within that one standard deviation move that the option market's got priced in. The 200 strike, if it gets to max profitability, that's only about 13% above the current share price in there. So offsetting some of the costs by selling the 200 call against your long 177.5 strike call. But I think the key with this one is even if you don't initially get that move higher, you've got some duration in this one. And because you're buying a directionally bullish vertical, it gives you some flexibility as far as trade management. If you get that move above 190, 195 post earnings today after the close, it opens up at those levels. This is going to really expand the price of this vertical relatively quickly, so you can close it ahead of expiration or maybe parse down your position size if you do get the move to the upside, but you definitely need a move higher.
Okay. Thank you for that. And look, I mean, Wedbush has it as a top pick in the cyber name. I know that they felt there was momentum there. How about a more neutral example trade?
Yeah, a little bit more conservative, but it flips that positive risk-reward scenario here a little bit. So I looked at something short-term, just using the August 22nd weekly options. So an earnings type of example here, where it expires at the end of the week, taking advantage of that higher implied volatility. I looked at a short put vertical here, and it kind of, you're going to risk more, but you're going to make less, but then you're giving yourself better probabilities of success. So went out to that August 22nd weekly option, sold the out of the money 170 strike put, and then against it, because we want to stay risk defying going into any earnings event, by the 160 strike put. So a short $10 wide neutral to bullish put vertical. You're going to collect roughly about a $2.50 credit. That's what you can make, $250 with $750 in risk, but that's all the way below 160 to the downside. Now, that break even, if you collect $250 credit, going to be down at 167.50 over the next 4 days. That's about 5% below the current share price. And the probability that break even of 167.50 will be out of the money at expiration, which is what you want. You want the stock to be above that break-even level. That's about a 68% probability of finishing out of the money on that break-even there. So you've got better probabilities of success, which is why you're risking $750 to make $250 on the neutral to bullish short put vertical.
Okay. Tom White, thank you. Good look there at Palo Alto and some example trades for our viewers. We appreciate it.